partner had its own equity, always. And total equity was GP plus LP, always. So it reminds me, like, this is similar. It's similar. You know, why did we split general partner and limited partner in every single investment partnership? Because the investment partnerships inherently wanted to split limited partners and general partners, because the general partner is the portfolio manager in charge of running the fund, has some equity in the fund and all control of running the fund. Limited partner is an equity investee in the fund that's participating in the earnings of the partnership, but has absolutely no operational power or control. So why do you split equity into different streams like that? Usually it's the power associated with that equity stream. You know, I was really familiar in the partnership realm because that was the realm that I worked at. But if you look closely at corporations, you'll see the same exact thing in corporations. If anybody ever look, I know the example they always use, like, you know, Berkshire Hathaway's Class A shares and Class B shares. You guys have heard that example? That's what, I don't know why they always use like that example. But the idea is like, you know, one is trading at like 65,000 a share or something, or 125,000. The other one is $200. So why is one trading like 125 and one's trading at $200? You know, simply because the 125,000 share thing is that's probably voting shares. There's probably voting shares, and there's not that many of them outstanding, and you know, they're owned by the people who are close to the investment entity, the insiders, literally inside entities. And the rest of the piece is public equity that is non-voting public equity. What is non-voting equity in this situation? Means that in the board of directors meetings, they don't have their vote regarding corporate issues. What kind of corporate issues are there? Usually, any fire, hire management decisions, right? Fire, hire auditor, fire, hire lawyer, right? So that's the idea. Like, once you sort of see, if you guys start doing like audits, when you get out into the world a little bit, you'll see one of the things that auditors get into is overviewing the board of director minutes. It's like one of the audit things. So by doing that, I remember over the years, I would just like find out, what does the board do? I never knew, but like looking at their minutes, you find out, oh, like all they're doing is they're firing auditors, or they're hiring auditors, or they're firing management, or because that's the biggest impact that you can make on a company, right? How do you shake things up? You change the management. Well, do you have the power to do that? Only if you have voting stock. So an example. So this is another power split in equity in an ownership, because we have here two streams of equity. One is called common stock, and the other one is called non-controlling minority interest. So that's basically why we're splitting it. So now what we're going to do is a few things we're going to start with now. One thing is we're going to look at the minority interest. We're going to have to do a couple things with it. First, we have to figure out at inception, what is the value of the minority interest? So like the conceptual objectives for like this half-an-hour study is to figure out what is the value of the minority interest at inception. That's one. Two, how does it get affected when the company makes income? Three, how does it get affected when the company has dividends? And four, how do you compute the final balance after the year end? So those are the four goals of mine for this 30-minute lecture, and they're all written on there. Like, you know, and that's the project I'll have you guys do for 10 minutes in your group after. I want you guys to learn these four things and then right away apply them in your group. And that's what the next, these 20 slides are about. So when you acquire something, the best way to think of the minority interest valuation is just like the investment account, right? What is the valuation of the investment account when you acquire a company? Purchase price, right? So the minority interest valuation is purchase price times the non-controlling percentage. So if you're buying something, it costs you $100 million, right? You went and you bought something. You went, say, whatever, Instagram, say it would cost $1 billion. Fine, so it cost $1 billion. But they sold us only 80%. They wanted to keep 20. So if, say you bought Instagram, 80% of it, right? The implied valuation is actually $1 billion. The implied valuation is $1 billion. You actually paid $800 million because you bought 80%, right? So what is going on with Instagram? What are they doing? They are keeping 20% to themselves. But say, your Facebook, so you're going to consolidate that Instagram onto your books, and you're going to call it the Facebook Consolidated Report. But on that book, you're going to have to show what? How much minority interest regarding Instagram in dollars would you have to show? How much of Instagram do you not own? 200 million. So even though, think about the sort of conundrum that you're in. Even though you're showing all the assets and liabilities of Instagram on your assets and liabilities on your balance sheet, the fact of the matter is that you don't own all of them. You only own 80% of them. So there's an accounting error right there. How do you reconcile this accounting error? You have to account for this piece that you don't own in your equity section called minority interest. Because then you're like, yes, it's true, I am including all the assets and liabilities of Instagram on my balance sheet, and the amount for that is true, it's $1 billion. But the fact is that it's true, I only own 80% of these assets and liabilities. So what I'll do is, I'll put in the $1 billion on my assets and on my liabilities, that's $1 billion, but I'm also going to state that on my equity, I'll say, you know what, but these folks over at Instagram, also known as the Instagram shareholders, for example, own 20% of this investee company called Instagram that we acquired last year. So 20% of the assets and liabilities that have been consolidated and called back then Instagram are now representing the minority interest that is disclosed on our statement of equity. So, and what is the actual dollar amount? 200 million. 200 million, because that's how much of the assets and liabilities you don't own. That's how much, who owns those assets and liabilities? Former shareholders of Instagram. Former shareholders of Instagram is still, what do they now have? Is like basically they have ownership in your company. You know what I mean? Like it's the piece of the company that you don't own. So how did we assign that? How do we assign this 200 million to this minority interest? We said from inception, we said 200 million. How did we get there? We said, listen, pretty easy. The implied valuation was 1 billion. So the implied valuation of the non-controlling interest is 200 million because it's 20% of the 1 billion. So that's the first piece. We determined the inception valuation. Now the book goes into a situation here. Before I move on, I just want to the book is sort of going into a concept here, sort of a little bit to the side, but I think is interesting. The idea of control. The idea of control, and why does control come usually with a premium? Why does it come with a premium? So like, Well, in a way, have you guys seen anybody seen the Facebook movie back in the day when it came out, like 3-4 years ago? Wasn't it kind of like, it's funny, like a lot of times people try to buy out Facebook, and what did Mark Zuckerberg tell them? He's like, get the hell out of here. I don't want to talk about it. Like, they kept telling him, like hedge funds in San Francisco, venture cap, listen, man, I have 50 million, I have 100 million, like, let's do this, let's make this deal. He's like, no. So, like, people get sensitive around control. When it's their firm, it's their baby, it's like their asset. Like, I don't want you to get in here, it's not ready yet. Like, so there's a control premium. So when you do want to get control of something, it's not going to cost you the fair value, usually. And that's why in mergers and acquisitions, there's always this concept called the control premium. And the control premium, traditionally, I think, like on average, it's something like 20%. It's 20%, just so that people let go of the idea that they still own this firm, that they still own this asset, and you change the ownership. So that can shift like how much things are worth outside the fair market value realm. So it's like if you're talking about like financial theory, you know, you could talk about sort of what I mentioned before, like the fair value of any asset is the present value of future cash flows. That is a theoretical financial concept that works. But control is it's not part of that concept. It's like, you know, I would say if a company is going through a merger and acquisition type of mentality, its fair value is the present value of future cash flows plus what is known as control premium, which is 20-30% extra if you want to control. Power. People love power, no? Like, so they want to control. So that's the one aspect. And then what's the idea of allocating goodwill now? So when we assign goodwill to companies, you know, in a way we have two things here. When we acquired Instagram. So two things happen, right? So Facebook acquired Instagram. So keep in mind, with no dissolution left, how do we account for Instagram as Facebook going forward? Investment into Instagram. We don't dissolve it. We just say it's investment into Instagram, and we continue to account for it, investment into Instagram every year, like investment into Instagram. That's how, you know, we're moving on, we're moving forward, just like chapter 3. So that's part of the idea. But that's only 80%. So how much is going to be the first year? Say we're go back to chapter 3 and 2 for a minute. What's the first amount? What would Facebook record investment into Instagram if they bought 80%? 800 million. So that's going to be known as investment into Instagram, 800 million. But the entity valuation is 1 billion. So on the consolidated report, we eliminate that investment, right? That's for sure. But we have now a minority interest. And how much is the minority interest? 200 million. So the idea is that basically controlling and non-controlling interest equals the entire acquisition date fair value. So the acquisition date fair value was 1 billion. You split that up into, you know, the controlling interest and the non-controlling interest according to the percentages. So if you have $1 billion acquisition, that means the implied value of the whole company is $1 billion, right? The investment was 80%, so that's 800 million. The minority interest was 20%, so that's 200 million. Together, they're $1 billion. So now we start looking. Now we start examining, and we're starting to see what was the fair value of the assets that are attributable to the controlling interest. So if Instagram was worth $1 billion, but the fair value of the assets was 800 800, 500 million. So the fair value of the assets was 500 million, but the valuation was a billion. So what would be the goodwill? So 500, right? So the goodwill would be 500 million, right? So now how do we allocate that to the controlling and non-controlling interest? Exactly. So in a way, goodwill would just be allocated according to the relative fair value of the then identifiable assets. So this number, for example, would be 800 million. That was the fair value of what we paid for, right? The relative value of the identifiable net assets would be 400,000 here, because we have 500,000 of fair value times 4/5 gives us the 400,000. And 800 minus 400 gives us the 400 here, like you said. As opposed to the non-controlling would be, it would start off the fair value, it would be 200. And then 1/5 of 500 would be 100, and 200 minus 100 is going to be 100, right? And the cross, it would be 400 plus 100 equals 500. So in a way, it's like, it's not a complex sort of calculation, but you just want to understand that we're doing the same thing. We just have two different pieces to it. We have the controlling interest and the non-controlling, and we're allocating pro rata here, right? So that's sort of the only twist in this piece. So now, moving on to the next piece here, in terms of, sort of, why don't you guys, first get grounded in what is non-controlling interest? Like, how do you compute the amount at inception? We sort of want you guys to understand that. You have the amount at inception. Now you can affect it in two ways. Is income and dividends. Income and dividends. Now, if you know the beginning balance or the balance at inception and you know the income and dividends, you'll know the total balance of the minority interest at year end. And that's sort of the goal for this 45-minute piece here, is to know the roll forward, the minority interest. So how do you figure out the net impact, the net income effect on minority interest? So what is minority interest, again, sort of conceptually? I think this is sort of a really big part of sort of getting deep down into how to work with this whole chapter. What is the minority interest? Is it not the consolidated entity's piece of equity that it does not own? If you look at the consolidated entity, for example, Facebook consolidated reports, what is the minority interest as it relates to Instagram? It's the consolidated Facebook and Instagram piece as it relates to Instagram that Facebook does not own. Sounds a little obscure, but if you're that 20% of Instagram, it's not obscure to you, because you're about to get a lot of money, right? Because you're going to get 20% of the whole profit for that year. So it's not very obscure to you at all. You're like, I own 20% of this company. I need to get that 100 million, like, now. So how does that happen? What is, from our knowledge of how do we consolidate reports, how do you figure out the share of income that belongs to the subsidiary? And then of that, how do you figure out the share of income of the subsidiary that belongs to the non-controlling interest? So you start out within the subsidiary, and you look at the revenues less expenses, and you come up with a net income number. So you're like, this is the subsidiary. We're talking about Instagram. This is how much money they made, right? And now you subtract the excess acquisition date fair value amortization. So it's a slight adjustment because the idea is that since you marked up the assets of Instagram to their fair value when they got acquired, in order to figure out the exact income of this entity, you're going to do revenue minus expenses less the excess acquisition date amortization of fair value. Then you get net income adjusted for excess of amortization. Now, when you get this income, say Instagram made $300 million this year. Occurred on Jan 1, 2014. Now it's December 31, 2014, and I'm doing the books, I'm doing the audit for the company. I'm seeing the income of the company was $300 million. $300 million net income, boom. Say no excess amortization of assets for now, zero. How much of this amount belongs to Facebook and how much of this amount belongs to the old owners of Instagram? Right, so we have 80% of 300, which is the 240. The 240 is going to go to the parent, to Facebook, right? And 60 is going to belong to the minority interest, which is that Instagram, basically. So it's going to be 240 and 60. So how do you figure that out? Basically, you'll look at the net income adjusted, for example, adjusted, and then you apply the non-controlling interest percentage. And then the non-controlling interest share of subsidiary net income will come as a dollar figure here, which is in this case $60 million. Now, if you're the owner of Instagram, what does this mean to you? What does this mean to you? This says how much equity you're gonna have more equity in this consolidated entity in the way. You're gonna have more equity in this consolidated entity. You know, keep in mind you're operating, you're owning stock in a company that you don't control. So what does that mean to you? Imagine owning stock in a company that you don't control. You know, what does that really mean? It means, you know, a couple of things that are very important for you to know is that one is that you're very you have to be involved in the running of the business in a way so that the business doesn't go into the ground, right? You care about the operations of the business. You want to have legal protection that your value remains intact. You want to have the ability to have liquidity. So all these things, like you're going to want to know how much your interest is worth. So that's the valuation of your minority interest. So how does that affect? So now you know, for example, say you know it's $60 million. What was our beginning value of the minority interest? $200 million. And now how much are we adding to it from income? 60. So it's 200 and now it's 60. Now say we had a dividend distribution of 100 million. Say we had a dividend distribution of 100 million from Instagram. How much of that is going to affect the old owners of Instagram, the non-controlling interest, and how much of that is going to affect the majority owner, which is Facebook? So isn't it going to be 80? So 80 million is basically going to be payable from Instagram to Facebook, receivable by Facebook, right? 80%. And 20% of the 100 million is going to be distributed to the old owners of Instagram, is going to go to them. So as far as the valuation of the minority interest, how much would you put as a negative, as an amount right there? 20. Because that's what's affecting that part of the equity. It's just that group of people, that 20% group of people who own 20% of Instagram. So you started with 200. and then now you have 60 of income, right? And now you have 20 as a negative of dividends, right? So now how much do you have as total at year end? 240. 240. Great, guys. So this is great. So you have 240. Now what does the 240 represent? The 240 represents your ending value of the minority interest and next year's beginning value of the minority interest. And what does it really approximate? What is it? What have I just kind of walked you guys through how to do it? But now, what's the purpose of doing it this way? What is the minority interest exactly like? The process that we just went through. Didn't we go through it in chapter 1 and 2 a lot? Doesn't it remind you of something else that we used to do? The investment account. Approximating the investment account. If you look at it, if you sort of look at it from another angle, you'll see that the minority interest is the same thing as the investment account. It's the exact same thing as the investment account, because what is our purpose of, on the consolidated report of Facebook, to show a non-controlling interest in the amount of 240? What are we trying to represent? What is GAAP trying to do here? We're trying to approximate the amount of assets less liabilities, also known as equity, of the subsidiary that we do not own, that is represented on our consolidated report. If you try to go back to this intention all the time as you're reading anything related to this or doing anything, you're just trying to figure out to tell the creditors and the investors in the consolidated entity of Facebook, you're trying to explain to them, listen, there's a piece of this consolidated entity that we do not own. And we've worked hard to approximate the valuation of this piece. This piece relates to the 20% of Instagram that we have acquired, but we do not own that piece. And we have outside shareholders currently represented on our balance sheet. And their representation is based on the initial inception valuation of the non-controlling piece, as based on the total implied valuation price of $1 billion, which was, their percentage was $200 million. Then based on the past year's income of whatever, there's a $60 million allocation to them, or $50 million allocation, $60 million allocation to them, less the dividend that we had of 20, coming to an ending balance of 240. And that's what you'll just see on the report, 240. You'll see on the report 240. That's going to be seen on the balance sheet is going to be 240. But in a way, if you guys, the more and more you get into accounting, in any sort of class or business environment, the statement of changes in owner's equity, I'll tell you that, I'll tell you what, it explains to you how the equity is changing. And in a way, I used to work a lot with private equity, where we sort of spend a lot of time reviewing the valuation of private companies and like all the stuff that they used to do, and how they changed capital structures, bonds, warrants, options, and how do you sort of derive like income from all these things. So I learned a lot about how to look at capital structures. And capital structures, if you ever want to understand a capital structure, you got to look at the statement of changes in owner's equity, because that's the first question about a company to me is who owns the company? Who owns the company? Who has control over the company? To what degree each part owner has control of the company? Who can call the shots? To what level? To what degree level? Who are they? What are they interested in? Those are the type of questions you want to ask if you want to look at a company and try to figure out who owns it. Because before you're going to know anything about what happens with the company, you want to figure out who actually owns it. And the statement of owner's equity reveals that through the sort of split in types of stock. And now we're delving into this aspect of minority interest on a technical level, but in reality, it's really good to sort of understand what's going on here in terms of ownership structure, right? How else, guys, do you know about in terms of ownership of a company? Like, who has influence over a company? How else do you know? Do you guys know how else do you check who has influence over the company? It's good to know in case of an emergency, those people, they'll be around. You're going to want something. So it's usually the bondholders too, no? Because like that's the people who are going to be on you, right? Because if you don't pay your bond payment, like you're in trouble, I don't know, I don't have the money. Okay, we're coming in, we have to take over the building, we have to change. Like, it's like, it's like, that's the capital structure. You got to know who are those guys. Like, are they in the U.S.? Are they in Brazil? What are they going to want? Like, you have to know who owns your company because they're going to come and they're going to want something. Like, so that's how you find out from the balance sheet. That's why accountants, if you're a senior accountant, you know a lot about these things, and it can be very helpful in terms of running a business. So basically what you want to, if you're sort of starting to understand this piece, the non-controlling interest, what is the beginning balance? What is the net income of the subsidiary for the year? What's the allocation of that to the minority interest? In the subsidiary's current year, what's the dividend payment? And then what is the ending minority interest? You sort of want to understand, figure out exactly what you're looking for. So who can tell me what is minority interest? Yeah, Aiden. Yeah, the share of the subsidiary that you don't own. I like that. Anything else, sir, you want to add to it? Yeah, it doesn't have the, yeah. And in respect to income, what does a minority interest mean in respect to income? The minority interest receives a certain percentage, that percentage of income. But from the consolidated level, what does minority interest income mean? Investments is sort of the parent's piece that, like, you have a purchase, but the minority interest is the rest of it. Exactly. That's what I was looking for, Sheila. Thank you. It was, yeah. So she said it's the parent's income that doesn't belong to the consolidated entity. Right? That's what I'm looking for. In a way, if you go there, I think you have to, if you're with that statement, you have to grasp almost 90% of that. Because this is why we're doing it. That's why we're doing all of this. The rest is also accurate, but we have to go through it because that's the percentage of income that the consolidated entity is not theirs. We're showing the company as Instagram is fully ours. Like, to the naked eye, you would look at it and be like, oh yeah, we own that. No, but if you look a little deeper, if you look on the statement of owner's equity, look, they're showing minority interest. There must be a piece that they don't own. How much? That's 200 million. Okay, and look at this piece is also throwing off various incomes that are continuing to increase the value of the piece that we don't own. So if you notice, we're going to continue to track how much is it that we don't own. And that's the purpose of tracking the minority interest, is figuring out to what degree do we not own the subsidiary that's showing up on our consolidated report, and to what degree is income from this subsidiary is not actually ours, does not belong to Facebook. And that's why we do it. So that's the, yeah, question. Of the consolidated entity that they, how does, good question. I think it varies. I think it varies what is, because think about it, it's a very good question, because the idea is you're consolidating, Facebook is consolidating, say Instagram, I believe was a private company, no? It wasn't even public. So basically what is a very good, what is a private company? What does it mean? You know? There's no difference between like an Instagram and the corporation I started for like running CPA tax returns. You just a regular corporate document says there's 100 equity shares outstanding, say for example. So Instagram, all the owners owned a piece of that 100. So when Facebook bought them, Facebook got 80 shares out of the 100. So who still owns the other 20 shares? They were divided amongst the founders of Instagram. So Facebook, in a way, owns 80 shares of a corporation called Instagram. But Instagram remains the owner of 20 shares of the corporation formerly known as Instagram, right? But keep in mind, with no dissolution, nothing happens. They don't dissolve the old entity. So now you're starting getting into the legal structure, and that kind of controls the accounting. The legal structure is that Instagram is still a corporation that's alive and running on its own as a legal entity with its own tax ID, with its own reporting requirements, a non-public private entity. Now, it just so happens that 80% of this non-public U.S. tax entity is owned by a public U.S. company called Facebook. And that Facebook has its own reporting requirements because it's listed and with the SEC and all of that. But that's what Facebook worries about. As far as Instagram is concerned, they're like, we are a private company with our own tax reporting, with our own tax ID. We just happen to be owned by a public company to the degree of 80%. You know what I mean? So like from a legal and tax structure, they remain separate. And they continue running together, concurrently as separate entities. If we sort of do the non-dissolution. If dissolution has occurred, then I think you were saying, then they would, then you would like pay, maybe Facebook paid them, Facebook shares, and this and that, and things like that.